Okay, well, good afternoon, ladies and gentlemen, and welcome to the Payden and Rygel webinar. My name is Stephen Fletcher. I'm Head of Retail Distribution at GSFM, and on behalf of all the team at GSFM and Payden, thank you very much for joining us today. I'm pleased to be joined by Eric Souders. Eric is a Portfolio Manager of Payden's Global Income Opportunities Fund. Eric joined Payden and Rygel back in 2017 and is a Director and Strategist on the global unconstrained fixed income team with a focus on absolute return solutions. Eric is responsible for strategy implementation, risk management, and also performance attribution. Now, prior to joining Payden and Rygel, Eric worked as a portfolio manager at Guggenheim Partners. In addition, he worked as a portfolio manager at BlackRock, focusing on investment-grade corporate credit strategies. Eric, it's great to have you here. Welcome.
Cheers. Thank you, Steve. Very good to be here.
Now, Eric, before I hand over to you, the webinar will run for approximately 20 to 25 minutes, followed by your Q&A. You can enter your questions at any time via the Q&A box at the bottom of your screen. So I guess, Eric, just to sort of set the tone for the presentation today, it's obviously been a particularly tough start to the year for fixed income, and that possibly that's a understatement. For some sectors like investment grade credit, high yield, in 2022, it's been the worst start on record to a year. So our clients, I think, are very keen to hear how you've managed to navigate your way through this volatile period, how you're seeing markets right now, and importantly, how does the setup look for the Payden Fund over the next 12 to 18 months ahead? So maybe with that backdrop, I might hand over to you for the presentation, and then I'll come back on a little bit later and we'll run through some questions. So thanks, Eric. Over to you.
Fantastic. Thank you, Steve. Yes, quite a market environment indeed. The last 5 to 6 months, and particularly coming out of what's been a very extraordinary market over really the last couple of years. So I think in the presentation today, we have a few different sections: the good, the bad, and the ugly. I don't know if you've all seen the famous Clint Eastwood movie, but we feel like there are some things to be optimistic about. There are some things that are less optimistic, and then there are some pretty ugly things. And so we'll try and tie all that together, and then talk a little bit about how that's manifesting itself into the positioning of the fund and our outlook going forward. So I'll go ahead and just continue through the presentation here. So the good, the good really is a combination, I think, of a strong labor market. Fundamentals are in a very good spot from a starting point standpoint. That's really across corporate credit and securitized debt. And the labor market really kind of drives the broad economic backdrop in both the U.S. and developed and really even emerging markets as well. So the labor market is about as strong as it's been really going back a decade, particularly in the United States. Today, the unemployment rate has recovered post-COVID down toward the 3.5% range. And when we look at the labor market, there are effectively 2 job openings for every person looking for a job. And so the stickiness in the labor market, we think, is quite strong. And this has obviously had an impact on wage growth and inflationary pressures from a wage standpoint. But I think that when we kind of start from the lens that the labor market really drives things like consumption and just broad economic activity, we're in a pretty good spot in the U.S. and in most developed markets. The same can be said then in the Euro area, where unemployment is effectively at the lowest level it's been going back roughly 20 years. And so again, I think this just ties into the backdrop that labor is strong in both the U.S. and then other developed parts of the world like Europe. So no real signal yet that labor is concerning. In fact, quite the opposite. Labor is quite strong. So wage growth has been a positive as a consequence of the tightness of the labor market. And so when we think about the propensity to spend and how real wages look relative to prior periods, we have seen a significant pickup in wage activity in the U.S. So here we're showing two lines. One is the Atlanta Fed wage growth tracker, and then the other is the employment cost index. Now, the good news is people are in a much better position to spend and to service debt and to live their lives. The bad news is, wage pressures have led to inflationary pressures, broadly speaking, across the services basket, which I'll get to in the bad component of this presentation. But nevertheless, employment's strong, and wages are also strong. So, and that again, I think leads to sort of a position where consumers are in a much better position to spend than they were in prior cycles. So what we're showing here is effectively employment compensation growth since the start of a recession. And so from an inflation adjusted standpoint, coming out of COVID, we are effectively at levels that it took roughly 5 years there, that burgundy line in the GFC, for wage growth to reach levels that we've seen now just 20 months coming out of COVID. So that's a long way to say that wage growth has been very strong, especially coming out of the COVID time period. Obviously, the market was supported by fiscal stimulus that occurred throughout that time period. But nevertheless, I think that the point in time today relative to prior periods, whether it's the .com or the GFC, wage growth looks very good, and compensation on an inflation adjusted standpoint is quite strong. Household cash in a very good position. So balance sheets at the consumer or household level are in very good shape, as cash levels have kept pace with liability. So net debt is in a very good position. You can see that green line there at the bottom, a much different situation heading into the GFC. So again, when we kind of put the pieces of the puzzle together, which is a labor market being tight, wage growth being strong, and then household balance sheets being strong as well, those are three very, very strong ingredients. From a leading economic indicator standpoint, thinking about are things signaling a recession? Are there indicators that we're keeping our eye on? There's a variety of indicators that we're looking at with respect to recession, and what really, most of them are signaling no recession. In fact, all of them except for the one at the bottom, which is just consumer expectations. It's an interesting environment because the consumer is still spending, but the sentiment of the overall consumer is about as poor as it's been in multiple years. So a pretty interesting dynamic there. But nevertheless, when we look at things like average weekly hours, initial claims for employment, manufacturing, new goods, building permits, I think equity prices have actually now potentially breached that 20% drawdown level. So this may be a little bit stale. It's updated May 16. But nevertheless, the lion's share of indicators here are not signaling a recession. So we think the starting point there is pretty good. So that leads to the bad. So the bad is really, I would describe it as a three-headed monster, and that three-headed monster is decelerating growth, accelerating inflation, and then central bank activity. And really, those three pieces are connected. So higher inflation expectations and really higher realized inflation over particularly the last 3 to 6 months, have led to heightened hawkishness by central banks, notably the Fed out of the US. And then that is, as a consequence, led to a deceleration in growth expectations going forward. So for us, it's really important to try to kind of balance these three pieces right now. But you can very clearly see here an inverse relationship between the left-hand side and the right-hand side. Left-hand side, growth expectations have come down really globally in both advanced and emerging economies. And then inflation expectations have picked up significantly. And that's been obviously exacerbated by the conflict in Ukraine. One thing I think that's interesting to note is with respect to emerging market economies, inflation has been much more prevalent over the last couple of years relative to advanced economies. And we've seen emerging market central banks raise rates ahead of developed economies and developed central banks, which is not normally the case. In most normal business cycles, the developed part of the world is raising interest rates first, and the emerging market world is following. So that's actually one of the reasons why we've been constructive on emerging markets, because they're actually in a position to be able to cut rates, given most of those countries have raised rates to combat inflation over the last year or two relative to developed economies. So I think that's an important nuance. So inflation is pervasive across really all parts of the developed world. This chart here is showing euro area core and trimmed mean inflation. So trimmed mean inflation that takes out the outliers on both ends of the inflation basket. So we're seeing just material inflation pressures that are really broadening, which is reflected in that euro trimmed mean blue line. We're expecting at Payden, we're expecting inflation to subside. We do think that there are some early indicators that suggest that inflation might have peaked. We need to see a little bit more data, but trimmed mean PCE in the US, which is one of the favorite indicators by the Fed, has actually declined in 2 consecutive months on a year-over-year basis. And then we've also seen durable goods roll over recently, and inflation associated with goods has began to abate. Things like used car prices have begun to soften, if not modestly decline. So we do think that there are some signs that inflation may be peaking here. We would expect inflation to come down toward the 3 to 3.5% range by the end of this year. But again, I think that the market needs a little bit more data to say all clear in terms of inflation peaking. As I mentioned, inflation becoming much more pervasive across really all parts of the consumer basket, goods and services. The green line here shows fraction of items with price increases. The blue line is prices declining. A very stark divergence there. So nearly all components are increasing with respect to price. Real GDP has actually contracted in the U.S. over the last quarter. We expect that to reverse over the next quarter. The biggest contributor to that contraction was net exports, so effectively exports minus imports. So the U.S. had a significant amount of importing activity over the last quarter. We think a lot of that was a function of supply chain congestion. And large businesses trying to effectively bring goods online and increase imports to help stock inventories and be in a much better position to be able to deliver goods. So we did see a bit of a contraction there, again, heavily influenced by net exports, and we do expect that to reverse in the second quarter, and we would expect real GDP to be positive in Q2. Output is still lagging compared to pre-COVID in an area like Europe, particularly given the location there relative to the conflict in Ukraine. So we would expect the Euro region to be more affected from a growth standpoint and an inflation standpoint relative to other developed markets like Australia or the US. So we are less constructive on Europe, and growth there has struggled relative to pre-COVID levels. And as a consequence, we've seen a periphery spread. So Italy, Portugal, and France, we've seen spreads there widening relative to German bunds. And so from our standpoint, that's a function of the ECB becoming more aggressive with policy, although they have waffled a bit, kind of back and forth, hiking, not hiking. So the ECB does seem a little bit lost with respect to where their compass is moving. And so we think that that's caused volatility in some of the periphery countries, and we would expect that to continue. Rate hike expectations for the US and Eurozone have been revised up. That should not be a surprise given the inflationary backdrop. We do think that interest rate hikes are fairly priced now in the US and Australia. Actually, we think it might be a little bit overdone in the Australian market. But on the US side, we do think, kind of a terminal rate of 3% or so is fair. So the market is effectively pricing in a 2% Fed funds rate by the end of 2022, and roughly another 75 to 100 basis points thereafter. And we think that that's pretty fairly priced. Policy rate divergence across the developed world. This is just going to create, from our standpoint, more divergence across things like credit spread and just economic activity going forward. So we would expect divergence to continue with respect to policy rates. You can see at the beginning of 2022, the market implied policy rate was effectively very clustered there in the left-hand part of the chart, and you can see material separation now moving out to 2023 through 2025. So again, we think policy rates are going to continue to diverge, and that's going to have impact on economic separation and also just credit performance. I'm just going to skip this slide. I mentioned that our forecast is pretty consistent with what's being priced across the market. So I'll just skip that page. The Fed reduction of their balance sheet is just another ingredient in terms of broad economic, broad asset price volatility associated with quantitative tightening. So the Fed, again, has been a big harbinger for supporting risk assets the last decade or so. And so reducing their balance sheet does take liquidity out of the market. It's still going to be a $7 trillion balance sheet, kind of looking forward 1 or 2 years. So that roll off is happening at a pretty slow pace, but nevertheless, it does take some liquidity out of the system. The shape of the yield curve, talked about this on the recession signal indicators, not signaling recession yet. The yield curve did flatten quite a bit over the last 12 months, but has since re-steepened. Particularly when we look at the 10-year minus the 3-month yield, which we think the 3-month yield is a bit better proxy for actual overnight rates. So, we are closely watching the yield curve, but for now, the yield curve is not necessarily signaled recession here in the U.S. So that leads to the ugly, the good, the bad, and the ugly. The ugly has been the market experience the last 4 or 5 months. It's been extraordinarily historic, and that's been exacerbated by the conflict in Russia and Ukraine. So when we look at things like supply chain and just the reliance on the region, the Russia and Ukraine region, with respect to commodity prices and natural resources, it's very material, not just in the energy market, but in other more maybe non-focused areas of the commodity complex, asbestos, seed oils, raw nickel, wheat. Wheat has been an area of consternation. I think India about a week or so ago put a ban on exporting wheat. So we would expect kind of the commodity price volatility to continue as this conflict persists. And we think that's just gonna affect broad macro vol. I mean, you have more social unrest, and you've just got divergences across both developed and developing economies. So this is definitely part of the ugly. The first quarter experience from a return standpoint, extremely ugly for both stocks and bonds. There was really nowhere to hide. Both risk-free assets like U.S. Treasuries or developed government bonds moved materially lower in price. And then even areas like investment grade credit, tax exempt munis, all the way through your more aggressive areas like high yield corporates, emerging market debt, down between 2 and really 15 or 20%. And then of course the equity market also struggled. So we feel like the correlations that you would more normally expect and experience throughout economic and market cycles completely broke down during the last 6 months, and that's evident on this page here, where it's effectively been the worst 6 months over the last 30 years with respect to risk-adjusted returns across the S&P 500, treasuries, investment grade, and high yield corporates, and gold. So kind of a combination of those 5 components. It's been the worst experience going back 30 years. So a pretty rough time to own any assets really besides cash, but even owning cash has a negative real return given inflation. The global aggregate index, we're looking at things like total returns, just to kind of put this in perspective. The top right hand part of the page and then that bottom right hand box, I think really shows that's kind of the tail of the tape, if you will. I mean, the global ag, U.S. Treasuries, really going across all these categories was close to the worst quarter in history for the global ag, U.S. Treasuries, Euro government bonds, global government bonds, and then very close to it for areas like emerging markets, hard currency. So a very, very challenging quarter from a historic standpoint, really across the board. And then from a monthly standpoint, I mean, this should make sense. It wasn't really one specific month. It was really all of the last 4 months, January through April. We show total returns here on a hedge USD hedge basis going back to 1990 for the global ag. January through April were 4 of the worst months in the entire series. And what's interesting there is that first bullet point, a return of -5% for the first quarter. Not only was it the worst return in 32 years, it was the worst return by almost 200 basis points. So by far the worst return in aggregate there for the first quarter. And then again, each of the individual months, very, 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 very poor outcome. Now, correlations, I already talked a little bit about this, so I won't belabor it too much. I think the point is that you would normally expect an inverse relationship between treasuries and the excess return associated with corporates. That relationship broke down, which was evident on that correlation page. And when we've been thinking about, why that is, well, I think the answer, part of the answer is that in a more normal geopolitical environment like we've seen, going back 10, 20, 30 years, you would expect risk-free assets to be a safe haven. And people would be buying treasuries and developed government bonds to hedge their credit risk. In this most recent time period, the opposite has been the case. Risk-free assets in global government, developed market government bonds, those have not been a safe haven because of the exacerbation of the inflationary environment associated with that geopolitical risk, which is the conflict in Ukraine and Russia. So, whereas in the past treasuries would have been a safe haven, it's actually been the opposite. Escalation of that situation has led to greater inflation, has led to central banks moving rates higher, has led to those more normal correlations completely breaking down. So where does that leave us in terms of opportunities today? We think the fund is in a very good position going forward with respect to both yield and duration. So when we think about how we've navigated this most recent time period, the fund performance has of course struggled, but it's been consistent with what we've experienced historically. So the fund performance for the year is down around 3%. When we think about our more normal drawdown during a typical market sell-off, our drawdown has been between 2 and 3%, which, given the extraordinary market environment that I just laid out, really historic going back 30 years, for the fund to deliver a return that has been consistent with drawdowns and more normal market sell-offs, to do that in a very, very historic and extraordinary time period, we think is a testament to our ability so far this year to be able to navigate both credit and interest rate difficulty. So the fund stands today with a yield of just under 4%, and we're doing this in such a way where duration remains quite low. We do think interest rate duration is looking more interesting, given real rates are now positive in areas like the US, and just we think inflation expectations might be close to peaking. So we have been increasing duration a little bit, but earlier this year that was as low as 0.5. So I think we were able to sidestep some of the move higher in interest rates. And again, we've got a real nice yield going forward at roughly 4% there. From a credit standpoint, we did reduce credit risk in the fund by about 20% earlier this year. We did that in the high yield bond market. So you can see the allocation to high yield bonds and loans in the bottom left portion at just 2% is quite low by historic standards for the fund. So I think we did a nice job at reducing credit risk, and we did that at the end of January. We got a little bit lucky with the timing there. We felt like valuations were unattractive, and that the change in stance from the Federal Reserve from dovish to less dovish would affect interest rate and credit markets. So we did that at the end of January. The escalation in Ukraine obviously has led to high yield spreads widening significantly. High yield spreads are roughly 200 basis points wider relative to where they were when we reduced credit risk. So we're in a very balanced position today. We've got a lot of exposure to government bonds and cash. You can see about a 10% allocation in that bottom left quadrant. So a good running yield, a very, very well balanced portfolio, well diversified, and also a good amount of liquidity, which we think really bodes well in the current market backdrop. Cash has much better optionality today than it did 1 to 2 years ago. Final thing I'd mention on this page is just the exposure to floating rate assets in the bottom right quadrant, around 53% today. That was about 40 to 45% 6 to 12 months ago. So we have increased our exposure to floating rate assets, which has also helped given the broad interest rate backdrop. The next page shows the evolution of the fund. I won't belabor this one too much. I think there's a lot of good content here. Again, when we think about that opportunistic side of the portfolio, we brought that down about 15 or 20%. You can see on the right-hand page. So coming out of COVID, we thought there was a lot of good value, less so coming into this year. So again, in that credit reduction piece that I talked about, I think that's been a big part of our focus, which is bringing down that opportunistic exposure and putting the fund in a much more balanced position. I already mentioned return, so I won't belabor this one too much. And then we do have performance attribution that I'll just sort of leave for the audience, and then some other themes like the reduction to credit that I've already described. This page here shows our overall credit risk in high yield bonds at the top, that's cash bonds, and then utilization of derivatives by way of high yield CDX at the bottom. You combine those two kind of regions there, and you can see we are net short high yield. So it's a rare instance in which we've actually been net short a specific asset class. And then the black and the gray lines that are moving up to the right, that's the credit spread of both US high yield and Euro high yield CDX. So pretty good timing. And again, I think a good time to not have to rely on a benchmark and being able to take very, very specific views, and even a view that's net short a specific asset class, and really protect the fund. Interest rate reduction, I talked a little bit about this, that's shown there in the top right part of the page. So we have brought down interest rate duration over the last year or so. That's the blue line. That blue line has picked up over the last week or so, just given, again, we've become more constructive on interest rates. Mortgage credit, maybe I'll leave this piece to potentially the Q&A section, but we have become much more deliberate around where we're participating in the mortgage market. Home prices have gone up parabolically the last 6 months. Bondholder friendly structures have weakened, and macro volatility has picked up, and liquidity has also declined. So when you put these ingredients together, we're more cautious on the residential mortgage credit market today, specifically some of the more on the run transactions. So we've sold all of our subordinated exposure there over the last 1 to 2 months. And prices have gone down between 10 and 20 points since we've done that. So we had good timing there. And maybe I'll just leave it there, Fletch. I'm going to go ahead and hand it back to you. I think that's been about 25 minutes. So we'll open it up to any Q&A. Thank you.
Terrific. Well, thanks very much, Eric, for the presentation. That was great. Ladies and gentlemen, if you do have any questions, as I said earlier, feel free to just go to the Q&A box at the bottom of the screen and send your questions through there. But I might just sort of start with a couple of questions, Eric. And we sort of discussed that the Payden strategy is an absolute return strategy, seeking to deliver positive returns with that downside protection piece, a capital preservation piece. So what, over an investment cycle, what levers do you pull to achieve this on a consistent basis?
Yeah, so I think it's the starting point for us is the credit work that we're doing. So when we've got 200 or so issuers in the portfolio, every single issuer and every single bond needs to be able to stand on its own 2 feet, needs to be able to withstand stresses that our credit teams run across all the asset classes. And that really served us well throughout the COVID time period, where we were able to re-underwrite the fund multiple times. So you've got 7 or 8 asset classes in which we participate. With just 220 issuers, that's roughly 30 across each of them. And so we can really get our arms around every single position, and we can do that in short order. And so coming out of COVID, that was very important. And we had no impairments throughout the COVID market experience. So I think, Steve, that the underwriting and the way that we think about risk management from the number of issuers standpoint, that every issuer must stand on its own 2 feet, that's really the starting point. That's the foundation of what we do is credit work. Secondarily, it's utilization of tools at our disposal. So things like derivatives. So when we want to bring down or even increase overall fund beta, we can do that in very short order, and we did that earlier this year. So I think having that flexibility is really key, and that translates into the interest rate market as well, where we can just dial down duration or increase duration if we believe that we're being appropriately compensated. So I think that's the second key. And the final piece would be, the utilization of options and other sort of unique instruments that can help dampen drawdown during adverse time periods. So I think it's a few different key ingredients, but the ballast and the hallmark of the strategy is really the credit work that we do, making sure every security has a place in the portfolio.
Okay, so in the context of where we are today in markets, with conditions expected to be, remain highly volatile, how important will a flexible approach to fixed income be in this environment, do you think?
I think it's extremely important. I think that's already been proven so far throughout the year. When you look at the performance of the fund, for example, versus a traditional benchmarked solution, outperforming investment grade corporates by almost 10% so far for the year. So I think being able to have flexibility around duration, we can increase that, up to 5 years if we want. We can take that down to 0. So having that flexibility, and then also at the bond selection level, so not being forced to own certain things that exist in a benchmark just because they exist in a benchmark. So you have certain characteristics in benchmarks that as a manager that's managing to that benchmark, you need to own some of that exposure. We don't need to own anything in this strategy. Our starting point is cash. So we can be very, very specific around where we place our exposures across really the various asset classes, and then also the population of those asset classes underneath the hood. So high yield corporate credit, for example, yes, we've been net short that asset class at the headline level, but we've also found some good value in double B bonds and the energy part of the high yield complex so far this year. So I think we've been able to source good, clean income on the cash side, but then be creative and overlay some derivatives and bring down exposure by way of that flexibility. So I think right now is the time to not really be worried about managing to a benchmark and having as much flexibility as you can. And so going forward with a 4% yield and a duration of just over 1, that stacks up really, really well relative to most traditional investment grade rated benchmarks.
Okay, great. Just looking at that slide you've got there now, the sector breakout. So expanding on the universe of investments available to you within the strategy, securitized today makes up, I think, the largest percentage of the portfolio. I know this may not always be the case. However, can you talk more about securitized in more detail? Why you like it, and maybe some examples.
Yeah, sure. So securitized is an extremely broad category, and I think that just maybe taking a step back, the GFC is arguably the best thing that could have happened to the securitized credit market. So when we look at the market today, it is materially different than it was 15 years ago. It's really not even comparable in terms of just underwriting at the loan level. The standards there are much more disciplined and much more consistent. Transparency that you get in terms of structural features and protections, much more bondholder friendly than they were prior to 2008. And then also the availability of data. We can really drill down across all of the various collateral types within the asset-backed market, both consumer and commercial ABS, the CLO market, the residential mortgage credit market, and of course the commercial real estate market. So data availability today is as good as it's ever been in that market. And you can get very specific around collateral and slicing and dicing deals and data to determine exactly what you think outcomes might look like, and really stress testing those securities. So from our perspective, that starting point is critical. The asset class is very different than it was 15 years ago. The second thing is, I think securitized is unique because you're able to pick your part of the capital stack in which you want to participate. So you might look at a CLO transaction, for example, you might love the AAA part of that deal, but you might not like the BBB part of that deal. So when we think about the fund, the opportunity versus stability exposures, securitized can populate both of those boxes very well. Corporate credit doesn't really serve that same purpose. So I think that being able to pick your spot in the capital stack in a securitized transaction is also another very important feature. The next thing I would mention is that the availability of different types of collateral has expanded significantly the last 10 years. So we're really able to source real nice diversified exposure across the 4 main food groups of securitized. And then that just reinforces the diversification of the fund. The final thing I'd mention is that the rating agencies, we believe, have overreacted over the last 15 years coming out of the GFC. And so we think a lot of the transactions are misrated. So our starting point is to re-underwrite every security in the portfolio. Securitized, obviously that same thing applies. And so when we re-underwrite these securities, we often find that our underwriting standards are still very, very onerous with respect to stress testing, but we think that these securities tend to be misrated because rating agencies have overreacted coming out of the GFC. So securitized today for us, it offers a fundamental picture that's very strong. Again, we are being very targeted with respect to where we're participating. Commercial real estate, for example, we've been constructive on the industrial part of the market, the multifamily part of the market, but less so office and retail. So it's really important to be targeted, but I think the broad backdrop is still supportive for securitized.
Okay, thank you. Just a question just come through here, and I think you may have already answered this, but are you worried about another subprime crisis in the mortgage bond sector?
No, I think because, again, the underwriting standards are not even comparable to what they were prior to 2008. So Documentation is much more strong today than it was 15 years ago. Underwriting standards are stronger. So from a subprime blow up standpoint, we don't think that's really the right way to think about it today. What we do think though is that there could be asset devaluation, especially coming out of an inflationary period. So we're being very cognizant of the run up in asset prices, especially on the residential mortgage credit side, which I already talked about a bit. And I think that the outcomes there could be more severe from an asset devaluation standpoint. So we're very focused on seasoned transactions that have significant deleveraging at the property level, loan to values down in the 50s and 60s. And we're much less constructive on new issue transactions where effectively every transaction is peak property price. So I think, again, the underwriting standards much better, which will likely lead to lower loss experience, but we are being cognizant of potential asset devaluation.
Okay. Just again, while we're on this slide, I think just looking at the opportunistic side of the portfolio, there you've got GSE risk sharing, and I think possibly it's a sector that our clients may be less familiar with. Can you describe this and again talk about maybe an example?
Yeah, sure. So the GSE risk sharing, the GSEs, the government-sponsored enterprises in the United States, so Fannie Mae and Freddie Mac, this is a program that was born out of the GFC, so came out of Dodd-Frank regulation. It really has required Fannie Mae and Freddie Mac to effectively transfer credit risk, so it's also called the credit risk transfer market, transfer that credit risk from the public sector, the taxpayers, into the private sector. So we've been involved as a firm in the agency mortgage market going back nearly 30 years. So we have a couple of agency mortgage dedicated funds, various clients that are focused on the agency mortgage market as well. And so, our relationship with Fannie Mae and Freddie Mac goes back 20 or 30 years. So there was great continuity there. This program, I think, allows us to participate really up and down the capital stack and incorporate exposure that makes sense in both that opportunity and stability part of the portfolio. So you're looking at transactions now that have very short weighted average life, so 2 to 3 years, with yields in sort of the 3 to 4% range. So on the stability side, all the way through, yields in the, kind of high single digits on the opportunistic side. So it's, I think it's an asset class that we know very well. We've been involved with it since its inception in 2013. We've got good relationships with Fannie Mae and Freddie Mac. The underwriting standards have been very strong, but the market is changing, and we've become, I think, less constructive again on some of the newer transactions. But it's played a role in the fund for many years, and it plays a role today, but a much more targeted role, just given some of the latest market volatility and developments.
Okay, so maybe just thinking about the next sort of 6 to 12 months, what do you think is the most attractive sector? Where do you think you'll be increasing your allocations within the portfolio?
Yeah, so we brought high yield down to, as I mentioned, a net short position, and spreads there have widened, 200 to 300 basis points. So when we look at the high yield corporate market now in the U.S., Europe we're less constructive, but in the U.S., spread levels now are beginning to be consistent with levels that you would expect going into a recession. And so when we look at the broad fundamental backdrop, corporate profitability, profit margins, leverage has been coming down in the high yield market for the last year or two. Supply, there's not been much supply in the U.S. high yield market, and there's not a lot of supply that needs to come to markets for the next 12 months. You combine that fundamental backdrop with credit spreads that are now 200 basis points wider, with sentiment that is very, very poor. We think that those three ingredients, when put together, begin to make the high yield market look more interesting here. So I would expect that, we think that dispersion is going to continue. We don't think we're out of the woods with respect to macro volatility. It's obviously impossible to time things perfectly, but we would expect that allocation to high yield bonds and loans there at 2% to pick up over the next month or two as the market continues to kind of process the Fed, inflation, and then the geopolitical situation in Europe.
Okay. So this is a question sort of closer to home for us anyway after the weekend. Any implications of the recent change in Australian government for fixed income markets in Australia? Have you got anything you can comment on that?
I think time will tell. It seems like, coming out of COVID, maybe the lockdowns were, maybe a bit too onerous for voters. So I think that it's an interesting shift. We'll see how it affects the Australian market going forward. I don't have any specific view at this time. We do think, though, that the RBA is a bit overpriced with respect to where the market is pricing the RBA. We don't think that base rates here will increase, north of 2%. We think that would probably have material implications on the housing market in Australia. So we would expect, base rates there to not rise as much as the market expects. But I think time will tell in terms of the new administration. They've obviously got a lot of things to consider.
Okay. And Eric, look, I think we're coming up close to our time limit here. We've got clients who are invested in your fund, the Payden fund. Would you like to leave them with any sort of final comments before we wrap up the webinar today?
Sure. Well, I think, first of all, thank you for joining, and thank you for the confidence in investing in the fund. I think that it's been a very unique time period, not just this year, but really the last 2 years. And we've come out of an extraordinary experience with COVID. And I think that the last 4 or 5 months have been sort of the icing on the cake for the volatility of the last 2 or so years. So we think the fund has navigated these markets pretty well, and we're in a good position today to take advantage of opportunities going forward. We don't think the storm is over, but when we look at forward-looking returns going back over the last 10 years for the fund, when we get to yield levels of 3.5% to 4%, the bar is extremely high for a negative return going forward. So we think the prospects of total return from here on out look really good, especially when we consider the amount of liquidity that we have in the fund at 10%. So if we just reinvested that liquidity back into the profile of the fund, the yield would be well north of 4%. So we have the ability to, I think, take more risk and increase beta. We're not quite there yet. We're beginning to think about it. But on a go-forward basis, we think the fund is in a real good position, especially compared to more traditional fixed income. So yeah, thank you all for your time.
Well, thank you, Eric, on behalf of everyone, on behalf of our clients and also everyone at GSFM. Thanks for your time today. We really appreciate it. And we look forward to speaking with you again later in the year.
Thank you, Steve. Cheers.
Ladies and gentlemen, that concludes the presentation today. Thanks again very much for joining us. On behalf of GSFM and Payden, thanks for your ongoing support. It's been terrific. If you have any questions, please feel free to go back to your BDM and pass those through. And we'll make sure we come back to you with answers to those questions. A copy of the presentation will be sent to you shortly, and CPD points will follow also. Well, once again, on behalf of all of us here, thanks again for your time, and we look forward to seeing you all again very soon. Thank you.